The baptism of fire awaiting new European Central Bank boss Christine Lagarde. We enlist the bank's own former chief economist and some thoughtful financial figures to spell out the downsides of negative interest rates and wholesale bond buying. But first, today's big topic. And running the vast European Central Bank has to be the most important economic job in Europe. But after 8 years, there's a changing of the guard behind that huge illuminated euro currency sign in Frankfurt. Out goes the dapper, urban and quietly spoken boss Mario Draghi. In comes nothing less than a political superstar from the global elite. Christine Lagarde, former athlete, turned finance minister, turned International Monetary Fund chief. So today we look at the European Central Bank. With public dissent in the ranks over the past few days, can Ms Lagarde steer the Eurozone out of recession and back to the glory days of the Euro's debut 2 decades ago? Nigel Cassidy has this in-depth report.
They might not be partying like it's 1999 when Christine Lagarde arrives, but the financial world seems to agree that the ECB needs new thinking after 20 years. So far, it's pulled off a trick that many said was impossible. It's defended a single currency across 19 countries that use it and kept price rises below or close to 2%. And it's all done without any control over the financial running of those countries. Here's how her predecessor saved the day in 2012.
The ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
Whatever it took, under the last president, Mario Draghi, turned out to be ever cheaper borrowing and a bomb-buying conjuring trick borrowed from the US Federal Reserve called QE, or quantitative easing. This arguably stopped the economies of Europe from plunging into a 1930s-style depression. We'll get back to what QE is and how it works in a minute. But look busy now, because here comes the new boss.
Well, thank you very much, Mr. Chairman, and I would begin by asking for your indulgence. I'm actually very intimidated to appear before you. The only consolation I find is that many of you in this room probably find themselves in the same positions as I am. You're learning, I'm learning as well, and we come with all the goodwill, the determination and the enthusiasm for the cause that we are prepared to serve.
Enter Christine Lagarde, introducing herself here to the European Parliament. But her timing isn't great. Europe is seemingly heading right back into recession, and Mario Draghi has already restarted that QE bond-buying business to try and head it off. Only this time, a third of the ECB's council, led by Germany, France and the Netherlands, voted against it. So let's get our head round how QE works and why it's hated in some quarters. I challenged Markets.com's chief market analyst, Neil Wilson, to explain using no more than 2 trading screens. Let's see how this works on radio.
This is essentially the yield or the return that you get on a German 10-year debt. So 10-year bond. Back in 2011, for example, you can see on the chart that investors would expect a 3% return. Now we have negative yielding debt. This is the sort of new normal in a sense, and certainly for Europe, investors are essentially paying the government of Germany to lend them money.
Now, with another chart here, this one is called ECB balance sheet. It's a pretty steady line up until late 2006, and then something starts to happen.
Central banks will maintain a stock of assets on their books as standard, and then as we approach 2007, 2008 and the global financial crisis hits, the bond buying starts. You start to add and bring assets onto their balance sheet, and we see this balance sheet of the ECB rise very rapidly, continuing to rise now in 2019.
So what is the European Central Bank buying that is producing this chart here to come up?
So the European Central Bank buys the government debt, the bonds issued by the various countries that exist within the Eurozone. What that does is it increases the money supply, so they create digital cash
So they're buying these bonds with money that doesn't really exist, that they've created.
Yeah, so that's why, the critics always talk about they're just cranking up the printing presses, they're creating new money like Germany did in the 1920s. It's not quite like that. They take the bonds onto their balance sheet. The people who used to own the bonds now have cash, which is much easier to invest, much easier to spend. By the ECB buying bonds, what it does is it drives up the price because there's a buyer in the market that's gobbling up all the assets and it suppresses the yield. It lowers interest rates because the bond yield that you see on the charts is actually the real interest rate, and that makes it much easier for businesses and consumers to borrow money, and then either if you're a business to invest it, or if you're a consumer to spend it to buy a new car, to upgrade your mortgage, whatever it happens to be. It helps grease the wheels of the economy.
Why is this renewed bout of bond buying proving very unpopular, in particular with Germany, almost a mutiny within the European Central Bank?
There's a philosophical argument against lowering rates, which predominantly the Germans, we're talking about also the Dutch, have maintained throughout. They're against having lower rate for what they think is the sake of it. There's also a sense that we've hit a point where you cannot lower rates any further, that you're getting much lower marginal gains from each time you lower rates. If you lower rates from 5% to 4%, you get a very noticeable improvement in economic activity traditionally.
Sort of diminishing returns.
Diminishing returns.
Neil Wilson of Markets.com. And now a song about QE. Really?
You know, baby, in the years I've been your central banker, we've done a lot of overnight repo lending. And it's been good. It's been so good. But the economic situation has gotten serious now. And baby...
That's Quantitative Easing, sung by Curtis Threadneedle. As the lyrics suggest, QE is far from ideal. Like most drugs, it has side effects. Years of rock-bottom lending and bond buying in Europe have pushed up asset prices, that's shares and bonds, and the cost of houses. And meanwhile, negative rates are really hurting savers. Peter Brown, Managing Director of Bagot Investment Partners in the Irish capital Dublin, sees it this way.
Zero interest rate policy was designed to spur growth and to raise inflation. Now, what it's actually really done, in essence, is raised asset prices, fair enough. It's raised equity and it's raised bond prices. But in terms of looking at it from the investment market, it's literally destroyed people's savings, returns on savings, and it's destroying pensions because, as we know, mostly 50% of somebody's pension goes into the bond markets, and that's now yielding zero, even though charges are still being applied to that side of the pension. These zero interest rates are destroying the wealth of savers and pensioners into the future, which is storing up a monster problem. If we look at the Italian economy, it hasn't grown at all, and there's been very little growth in France, and now Germany is starting to slip back into recession. And as Mario Draghi has said on numerous occasions, he said, I can keep interest rates low. He said, unless I get structural reform in the major economies, referring to France and Italy, I'm not going to achieve anything. So we had no interest rates. Now in Ireland, which is a very good example, we've had phenomenal growth in Ireland and a phenomenal recovery, but we haven't had low interest rates on the loan side because the banks are dysfunctional over here. Borrowing money, car loans, business loans, anything like that, it's still up around 8%. Deposit rates are zero, but lending rates are 8% because the banks are trying to make up for the fact that they don't make any money on the liability side of their balance sheet. So really, the low interest rate policy in Europe hasn't achieved anything. And what it is in reality, it's a tax on savers and pensioners to offset the national debt of Italy, Ireland, France, Germany, that Ireland can now borrow at 0% for 10 years. And that money's coming directly out of savers' pockets.
I'm Nigel Cassidy. This is World Business Report. Our big topic is the European Central Bank, about to get a new chief, Christine Lagarde. So what can she do in the face of all this? Maria de Mertzes is Deputy Director of the Bruegel think tank in Brussels.
Mr. Draghi has been, in all senses of the word, a real economics professor, an academic. Mrs. Lagarde is much more of a politician, I think. She has a very big political career behind her, huge international experience in terms of running big institutions, and she's not an economist. So I think these are differences that will probably show. I don't think one is better than the other necessarily. In fact, they both are extremely experienced people, but they are quite different. I think Mrs. Lagarde will try and bring the politics on board in terms of bringing the politicians to do what they need to do. And that would be a good thing if you believe that actually now it is up to the ministers of finance to try and do something to help the economy.
It's been said by a lot of commentators that Christine Lagarde is even more dovish than Mario Draghi, meaning she'll be even keener on cheap money, low interest rates, and that policy of Mr. Draghi will be continued, which will probably continue to more than annoy the Dutch and the Germans.
I think the markets expect that. If you look at the way that the expectations of interest rates and inflation have moved since the announcement that Mrs. Lagarde will become the new president of the ECB, it fits that story. I expect that there will be continuity in the ECB, and it will be continuity because there is a big machinery behind every decision that is being taken that will ensure that there is continuity, which is a good thing because predictability is good for the markets.
Maria de Merz is Deputy Director of the Bruegel think tank in Brussels. While we still need some insight from much closer to the ECB, and we did manage to track down Peter Praet, until very recently the chief economist and a close colleague of Mr. Draghi. He's effectively told those Dutch and German council members to pipe down.
I would say that the non-conventional monetary policies, instruments have worked pretty well, actually, when I look at the past. My point today is to say that the nature of the shock that we live today makes monetary policy not a very efficient instruments. It doesn't mean you don't have to act, but it means that, you need other sort of policies. When you think backwards, the global financial crisis, you had big monetary policy reactions, but at the same time, you had reforms of regulation, you have a recapitalization of banks, by the public sector. So you absolutely need a sort of three-pronged response. First, I think in Europe you have to maybe use fiscal much more than has been. But more importantly, I think even is that you need supply-side reforms, to create some positive shock, in business, which would more or less compensate the negative shock that you have.
And you're saying there should be more fiscal. You're saying the likes of Germany should invest more in their economies. Let us assume then that Ms. Lagarde manages to persuade Germany to do a little bit more investment and maybe also to go along with more of this bond buying. Isn't the problem that the ECB is running out of bonds to buy under its own rules? It might even have to start buying shares. So there are risks here continuing the QE.
No, there are risks with all monetary policies in general, and it's true with non-conventional instruments. I mean, many observers say indeed that, you reach the limits. I see the point here that you need to have some form of coordinated approach. So you are right to manage, the risk related to non-conventional policies. But at the same time, I think there will be other responses coming in the coming months. It's unavoidable. I mean, or the economic cycle will suddenly improve because, the trade climate will be better because Brexit is smoother than many people fear. That would be the optimistic scenario. And then monetary policy starts normalizing again, the cycle improves. And so all these questions we discussed will be irrelevant. The question is, of course, if the economy would fall in recession, what do? Monetary policy cannot be the solution to a recession. I think you will need, to have a sort of coordinated efforts, of the different parts of government. And I think that's unavoidable.
Peter Praet, the former chief economist of the ECB.
Quantitative easing.
So, task number one for Christine Lagarde is getting those internal critics on side. But perhaps more in her line will be influencing leaders outside ECB HQ, persuading Germany to spend and the likes of France and Italy to carry out more of the economic reforms that they promised.
That's why I'm ready to show them some very special central banking. Short-term interest rates are very, very low, my beautiful.
ECB's former chief economist Peter Praet ending that extended look at the European Central Bank with a little bit of music thrown in for good measure at the end.